Hey guys, welcoming you to Banker's Den, an authentic channel to understand banking concepts from a professional banker. Today we shall be discussing about history of banking and its evolution in India. At the end, we shall also briefly touch upon what are the types of bank in India. India saw growth of modern banking in 18th century with setup of Bank of Hindustan in 1770 and General Bank of India in 1791. General Bank of India failed in 1791. Subsequently, Bank of Calcutta in 1806, Bank of Bombay in 1840 and Bank of Madras in 1843 were set up by Presidency. These three banks, Bank of Calcutta, Bombay and Madras, were also known as Presidency Bank and later in 1921 got merged and named as Imperial Bank of India. These Presidency Bank acted as quasi-regulator till setup of Reserve Bank of India in 1935. Chartered Bank of India, which today is known as Standard Chartered Bank, was set up in 1858. This was also the phase in which country saw and spurred in foreign banks setting up their businesses in India. From middle of 1800 till independence, India witnessed rapid growth in setup of new banks. In this phase, Allahabad Bank in 1865 was established and Oudh Commercial Bank at Faizabad was set up in 1881, which was first Indian joint stock bank but later failed in 1958. Allahabad Bank, which was set up in 1865, was one of the oldest joint stock bank till it got merged with Indian Bank in 2019. During Swadeshi movement between 1906 to 1911, numerous banks were set up by politicians and wealthy businessmen of India. However, during World War I, almost 90 Indian banks were closed owing to a major downturn in Indian economy. During this phase, a lot of Indian banks failed and had to shut their offices. However, pre-independence Reserve Bank of India was set up in 1935 and it became a regulator with passage of Banking Regulation Act in 1949. After India got its independence in 1947, it was the time of consolidation and reforms in the Indian banking industry. In 1955, Imperial Bank of India was transformed to State Bank of India. SBI Act in 1959 was passed, which resulted in 8 state-controlled banks becoming associates of State Bank of India in 1960. During rule of Indira Gandhi, with objective of bringing better governance and control, 14 largest commercial banks were nationalized in 1969. These banks held close to 85% of public deposits. Later, in 1980, another 6 large commercial banks were nationalized. In the phase of liberalization, Life Insurance Corporation and UTI Trust of India set up UTI Bank in 1993. During the same phase, ICICI Bank and HDFC banks were amongst the first private sector banks to receive RBI nod in 1995. With foreign banks already being present in Indian market and some development financial institutions becoming bank, post year 2000, country witnessed banks reaching to the doorstep of customers for service delivery, which was unheard and was not seen in India earlier. In 2001, Global Trust Bank was merged with UTI Bank and later in 2007 renamed as Axis Bank. During the same year 2001, Kotak Mahindra Bank was set up as a result of banking license being given to an NBFC for the first time. 2005 onwards, multiple regional rural banks were formed to focus on taking banking penetration to rural area. With a focus on small ticket loans and digital payments, RBI in 2015 came up with differentiated banking license and set up small finance banks and payment banks in India. In India, there are multiple types of banks as per banking regulation. Most common term heard by one is scheduled commercial bank. Banks with minimum capital criteria, finding its name in second schedule of RBI Act, are known as scheduled banks. These banks are also eligible to take loans from RBI. The next category of bank is commercial bank, and as the name suggests, these are for-profit banks and could be scheduled or non-scheduled both. To ensure rural penetration of banking services, regional rural banks are set up by government. These banks are scheduled commercial banks and regulated by RBI. Another category is cooperative bank, which are not supervised by RBI, but the responsibility of supervision is with respective states. RBI also came up with differentiated banking licenses in 2015, which gave birth to small finance banks and payment banks in India. Small finance banks, as per the regulation, need to lend at least 75% of their net bank credit to targeted sectors, also known as priority sector, and would have majorly presence in non-metro cities. On the other hand, payment banks can only facilitate payments in digital manner. They are not allowed to assume any credit risk on its customers. Thank you for watching this video. Please subscribe my channel for watching upcoming interesting videos.